A bearish economic indicator just turned the most extreme that it's been in 40 some years. Should you be concerned? What's it telling us? I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show, most one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. There's no perfect indicator or predictor of the stock market. Forecasters tell you more about the forecaster than about the future. And famous Warren Buffett quote, I believe in that. And yet when you look back at different potential indicators, leading economic indicators, those sorts of things, the inverted yield curve, as geeky as that sounds, you're probably familiar with it, is actually the most reliable of economic and stock market indicators out there. And basically, the premise is logical as well. So when you look at borrowing money or lending money, okay, if you are going to, let's say, lend money to someone over a very short time period, so you're just going to give them a loan and that they've got to pay off in a day or in a week or in a month. You might charge some interest for your hassle and the little bit of risk, but because they're going to give you the money back so soon, the interest that you would charge likely is going to be pretty low because it's such a short-term loan that the risk is pretty mild. Compare that to maybe a month, a loan for 1 month. Compare that to a loan that you're going to give someone for 10 years. They're going to pay you interest a little bit every single month for over a 10-year time period, and then they give you your money back. You might expect that interest rate is going to be higher, right? Because it's going to take 10 years. A lot can happen over 10 years. So you'd expect that 1 month loan, that really short-term loan, would have a really low interest rate, and that 10-year loan would be a higher interest rate. A 20-year loan would be higher than that. A 30-year loan would be higher than that. That's a normal yield curve. That's how that should work. Right now, we have an inverted yield curve, meaning a short-term, a 1 month loan, a 3 month loan, a 2-year loan, those are going to be a higher interest rate than a 10-year loan. That is backwards. That underscores some dysfunction happening in the overall economy. That's what they call an inverted yield curve. And folks, while it's been inverted for, a year now, a while, it has continued to get more and more inverted, meaning more and more distorted. And just recently, last week, we hit the most distorted, most inverted that we've had in 40 years since the early 80s. Take a look at this. There's many different yield curves or inversion, points of inversion that I can show, but I'm showing you here the 2-year versus the 10-year. So this is showing that the 2-year loan or bond is at a higher interest rate than the 10-year bond. And I could show you the 3-month compared to the 10-year, and also they're all inverted for the most part. And so if you take a look at this, you can see that inverted, it's that short-term interest rate is about 1% higher than the long-term interest rate. That's the most inverted things have been since the last time we saw inflation this high back in the early 80s. But pay attention to this chart. When it inverts, what follows 6 to 9 months after that? Yeah, a gray shaded area, a gray bar. And what's that gray bar represent? A recession. That's right. And so you can see going back 40, 50 years that an inverted yield curve has occurred before every single recession. And if you go back even further, there are times when the yield curve inverts and we don't see a recession, but it is, 80-some% or 90, a significant amount of the time that a yield curve inverts, we'll see a recession shortly thereafter, within about 9 to 12 months. So, is there reason to be concerned about an upcoming recession? You might look at this and say, well, of course, if you get it, you might look at this and say, of course the yield curve is inverted. Of course, short-term interest rates are higher than long-term interest rates because short-term interest rates have been manipulated, pushed higher because of inflation. But we all know inflation is calming down and will continue to calm down. The Fed will do whatever it takes to calm inflation down. And therefore, longer-term interest rates are going to stay low because inflation and interest rates will come back down at some point. You might say, of course, so that doesn't necessarily mean there's going to be a recession. Well, listen, everyone thought that same thing back in the early 80s as well. Exact same thing. Inflation was so high, they knew that that was temporary. The Fed was going to do what it took to raise interest rates in the short term, but to keep or bring inflation back down. And of course, that it was going to create an inverted yield curve. Yeah, they thought the same thing back then, and yet we saw 2 recessions back to back, pretty severe and challenging economic times in the early 80s. What should you do about this? Well, should you fear a recession? I would encourage you no, right? Everyone, all sorts of forecasters expected that the first part of this year was going to be challenging. We'd see some sort of soft landing or hard landing or some sort of landing, which we haven't, and that the market wasn't going to be that great, the economy wasn't going to be that great. But then the second half of the year, that's when things would improve. And no, we saw no landing, is what I think experts are saying, at least right now. We got through a regional banking crisis, we got through a debt ceiling issue and all sorts of, and the stock market's actually been pretty strong. The economy, there hasn't been explosive growth, but it's been stable. I'd encourage you to stay watchful for a recession, but not plan on one, not predict one simply because the yield curve has inverted. Here's what I would do. From a financial planning perspective, you have to stay on guard for the potential of an economic downturn. And you don't do that just right now because the yield curve is inverted, but I certainly wouldn't ignore it. And how do you do that? Have a 3 bank account system where you've got an updated budget, you've got the right amount of margin in your cash flow just in case you need some shock absorber. You're saving up for known upcoming expenses so that you're not just, well, whenever that occurs, we'll borrow the money to take care of it. And so you've not done that. You've saved up in advance for known upcoming expenses, and you've got a fully funded emergency fund. If you've got that in place, then you've got the shock absorbers there that you can confidently save for your long-term financial goals, full steam ahead, as if yield curve's not inverted, or even if even if we see a recession, I'm prepared for it, something like that. So stay on guard that we could see some challenging economic times, but doing so via a 3 bank account system and a stable and prudent cash flow management system while you still save aggressively for your long-term financial goals. Work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.